Hello, hi guys. This is CA Balakrishna. How are you? Hope you people are doing well. Even I am fantastic. So till now we have discussed or revised first three chapters of CA Inter Audit, and in those three chapters we have covered SA 200, SA 210, right, and also all the basic introductory content we have covered, and we have also covered SA 300 with respect to planning, right. Now in this class we will be revising fourth chapter, which is with respect to risk of material misstatement. Basically in the today's class we will be covering almost 5 standards. SA-315 we will revise, SA-320 we will revise, 330, 265 and 450. All these 5 standards we will be revising in this chapter. So without any delay, let's start the revision. So fourth chapter, what is the name of fourth chapter? Of course it is risk assessment and internal control. What is meant by risk, how to assess risk, all these things we will see. First of all, here in this fourth chapter we are going to cover 5 standards, as I have already told you. First one is the SA-315, which is identifying and assessing the risk of material misstatement through understanding the entity and its requirement. Next, SA-320, which deals with materiality in audit of financial statements. Next, SA-330, which deals with auditors' responses to assess the risk of material misstatements, and SA-450, evaluation of misstatements identified during the audit, and finally SA-265. Now if you see, there is a interconnection between these 5 standards. So we will see what is the interconnection between these 5 standards and why we are discussing all these 5 standards together. So first of all, the audit that the auditor conducts is a risk-based audit. Risk-based audit means auditor, he will not do audit of each and every item in detail. No, he will first of all identify risk. What is the risk of material misstatement in a particular area? If the risk is high, the audit procedures that he will perform will be high. If risk is low, the audit procedures that he will perform will be less. Like this, the audit that the auditor conducts is a risk-based audit. Now, for doing a risk-based audit, first of all, you need to identify the risk of material misstatements. So, SA-315, as per SA-315, you will identify risk of material misstatement. Now, if you see, we are not calling just misstatement, we are calling it as material misstatement. So, if there is only just a misstatement, auditor is not concerned with it. If it is material, only then the auditor will be concerned with that misstatement. So, what is meant by materiality? We will be covering in SA-320. Okay, auditor identified the risk of material misstatement as per SA-315. After you identify risk of material misstatement, what you will do to that risk? Based on that risk, you will design audit procedures. That means you will respond to that risk, right? You will respond. How you will respond? By designing audit procedures. So as per SA-330, you will give your responses to assess the risk of material misstatement by performing audit procedures. Okay, by performing audit procedures, you will identify actual misstatements. Okay, as per SA-315, you have just identified risk of material misstatement, but by performing audit procedures for that risk, based on that risk, you will identify actual misstatements. Now these actual misstatements, they have to be evaluated, right? You have to take proper action by evaluating those misstatements. That will be done as per SA-450, which is evaluation of misstatements identified during the audit. Got it? These are the 4 standards. Now there is one more standard, SA-265. Now, as per SA-315, while identifying the risk of material misstatement, you will also evaluate internal controls. Now, if you find any deviations, deficiencies in the internal controls, you have to communicate those deficiencies to management or those charged with governance as per SA-265. SA-265 deals with how to communicate deficiencies in internal control with management or those charged with governance. So these are the 5 standards that we are going to cover in this chapter, and this is how all these 5 standards are interlinked to each other. Got it? Yes. So the first standard that we are covering, it is SA-315. Identifying and assessing risk of material misstatement through understanding the entity and its environment. This is the name of the standard. Now, before starting the standard, you need to understand a particular term, which is assertion. What is meant by assertion? See, assertion means a representation made by management to whom? To auditor. About what? About financial statements. That is known as assertion. See, now management, they will prepare profit and loss statement, balance sheet, and they will submit these profit and loss statement, balance sheet to auditor for the purpose of audit. Right now, by giving this balance sheet and profit and loss statement to the auditor, management is making various assertions in those financial statements. Example, in these financial statements, there will be assets, right, in the balance sheet, and there will be value for the assets. So by giving the balance sheet to the auditor, management is stating that whatever the assets are shown in the balance sheet, they belongs to company. Valuation that is shown in the balance sheet, that is accurate, properly valued. Like this. Similarly, with respect to profit and loss statement, there will be sales revenue in the profit and loss statement. By giving profit and loss statement to the auditor, management is making an assertion that whatever the amount of sales that we have shown in the financial statement, that is profit and loss statement, occurred in the current period, and we have not missed any sales, that is complete sales have been accounted. Like this, management will make various assertions to the auditor by submitting the financial statements to the auditor. Now, the duty of the auditor is to verify whether the assertions made by the management in the financial statements, are they correct or not. That's what the auditor will do in his audit. Right? Got it? Yes. So now let's see. Assertion means representation by management, either explicit or otherwise, that are embodied in the financial statements. Okay, assertions, they will be present in the financial statements, and these assertions, they can be with respect to class of transactions. Class of transactions means where the transactions will be present. In the profit and loss statement, transaction will be present. In the balance sheet, account balances will be present. Okay, so with respect to class of transactions, auditor will make assertion about occurrence. That is, whatever the transaction have occurred, that only we have shown in the profit and loss statement. Okay, whatever the transactions that we have shown in the profit and loss statement that have actually occurred, we have not shown any transaction which have not occurred. That means we haven't booked any fake transactions. That is the first assertion. Next, completeness. Okay, all the transactions that taken place during the year, we have accounted for. Accuracy, and they have been valued accurately. And cutoff means only those transactions that occurred in the current year should be shown in the current year financial statements. Right? Transactions of previous year should not be shown in the current year, and transactions of next year also should not be shown in the current year financial statement. That is known as a cutoff assertion. Next, classification. We have properly classified the transaction, that is revenue, income, the expenditure. Like this, proper classification of transaction has been done. Capital. Okay, capital expenditure should not be shown in the profit and loss statement, right? So classification also we have done it properly. Like this, auditor will make assertions with respect to class of transaction. Next, assertions with respect to account balances. Account balances means balance sheet. In the balance sheet, you will make various assertions with respect to account balances. So, first assertion is existence. Whatever the assets that we have shown in the balance sheet, they are actually exist with the entity. Whatever the liabilities that we have shown, that also actually exist as on 31st March. That is existence assertion. Next, rights and obligations. Whatever the assets that we have shown in the balance sheet, they belongs to entity, and that is known as entity is having right over those assets. And whatever the liabilities that we have shown in the balance sheet, entity is liable to pay them. That is, we are having a obligation. And completeness, similar to that of this assertion. Next, valuation and allocation. We have properly valued the assets. So this assertion we will make to the auditor in the balance sheet. Next, assertions about presentation and disclosure. So presentation and disclosure will be made in entire financial statements. So with respect to this occurrence assertion, that means all the transactions that have occurred, we have properly presented and disclosed. Completeness, classification and understandability. Okay, we have properly classified the transactions and account balances, and we have disclosed and presented them in such a manner that users will be able to properly understand them. Users will be properly able to read them. That assertion also will make. Next, accuracy and valuation. So these are the assertions that the management will make to auditor. Next, coming to the term audit risk. What is meant by audit risk? Before that, first of all, what is meant by a risk? Generally, you will use this term risk in combination with something negative. Okay, risk of failing examination, risk of occurring accident. So you will use the term risk to denote something negative, right? Now, from the audit perspective, risk of material audit risk means that the risk that auditor might give inappropriate audit opinion. Inappropriate means wrong audit opinion the auditor might give. That is known as audit risk. Now, there are two ways in which auditor can give inappropriate audit opinion. What are they? First of all, express unmodified opinion means clean opinion when the financial statements are materially misstated. In the financial statements, there are misstatements. If misstatements, you have to modify your opinion, but you are giving unmodified opinion. This is giving inappropriate audit opinion, right? This will affect effectiveness of audit. This is nothing but a audit risk. Okay. Next, another type of inappropriate audit opinion is express opinion that financial statements are materially misstated, but actually there are no material misstatements in the financial statements. Okay, actually in the financial statements there are no material misstatements, but auditor is giving an opinion that there are misstatements in the financial statements. Now this will affect efficiency of the audit. Why efficiency will be affected? Because you have to perform again more audit procedures to prove that there are no misstatements in the financial statement. So your resources are being utilized, so efficiency will get affected. So in this second situation, efficiency will be affected. But for the purpose of standards on auditing, you will not consider this second situation as audit risk, because this is very insignificant. This is not significant. Only the first aspect will be considered as audit risk. Next, this audit risk, it can occur either because of error or because of fraud. Now, what is meant by a error? Error means something that you will commit unintentionally. Okay, unintentionally, if you commit a mistake, that will be known as error. If you intentionally commit a misstatement, then that will be a fraud, right? So this is audit risk. Now, going to risk of material misstatement. Now, if you see, as per this standard SA-315, the major purpose of the auditor will be to determine risk of material misstatement. Okay, we'll call it as ROMM. Okay, so how to determine risk of material misstatement? Let's say, for example, there is cash. In the area of cash, how to determine risk of material misstatement? First of all, you will identify inherent risk in the area. What is meant by an inherent risk? Inherent risk means by birth there is a risk in that particular item, okay, which will be seen when there are no controls. Okay, inherent risk will always be calculated assuming that there are no controls. Let's say for example cash. For cash, what is the inherent risk? The inherent risk for the cash is theft. Okay, cash is subjected to theft. It is the inherent risk of a cash, right? So you have to first of all calculate inherent risk. Now let's say for example, in case of cash, the inherent risk of being subjected to theft is 80%. So inherent risk for cash is 80%. Okay, see, you will have to calculate risk of material misstatement for each and every item. Like for cash you are calculating, you should also calculate for fixed assets, for sales. Like this, for each and every item you have to calculate risk of material misstatement. Okay, inherent risk is 80%. Now if there is inherently a risk in a particular item, will you just sit like that without doing anything? No, right? You will try to reduce that risk, right? You will try to reduce that inherent risk. So for reducing the inherent risk, what you will do? You will implement controls. Like you have implemented CC cameras in the organization to reduce inherent risk of theft of cash, right? So you have implemented controls. Just a second. Sorry, just a small call. So you have determined inherent risk. Now to reduce inherent risk, you have implemented controls. Now what is the guarantee that the controls that you have implemented will work properly? What is the guarantee that the controls that you have implemented will completely reduce this inherent risk? No, right? Because the controls might fail, right? So now the risk that controls might fail is known as control risk. Let's say for example, the risk that controls might fail is some 50%. Okay, so 50% there is a risk that controls will fail. That means the controls will be able to reduce the inherent risk only up to 50%. Remaining 50% of the inherent risk will be there like that only. So let's say for example, the risk that controls will the risk that controls will fail is not 50%. Let's say it is some 10%. Okay, so the risk that controls will fail is 10%. That means they will reduce inherent risk up to 90%. That means 90% of this 80% will be reduced. Okay, only balance 10% of this 80% will still exist, right? So control risk is 10%. So 80 multiplied by 10%, you will get how much? 8%, right? You will get 8%. This 8% is nothing but risk of material misstatement. Got it? So now you have calculated risk of material misstatement. So the risk that there will be material misstatement in the cash is 8%. Now you should always remember that this risk of material misstatement, it will never be in the hands of auditor. Okay, the risk of material misstatement, before the auditor has come to the audit itself, that risk of material misstatement is present. Now auditor is there, na? Auditor before starting the audit, he will decide a particular risk. Okay, let's say he will decide audit risk. He will determine his audit risk as some, let's say 2%. That means auditor is okay if there are 2% misstatements. Okay, he is okay to accept risk of audit up to 2%. Now, but actually the risk of material misstatement is 8%. He has to reduce this 8% risk of material misstatement to 2% because his acceptable risk is 2% only. Now, how to reduce the risk of material misstatement of 8% to 2%? We are having a formula. Audit risk is equal to risk of material misstatement multiplied by detection risk. Sir, what is this detection risk, sir? Let me tell you. I'll tell you what is detection risk. I'll tell you. First of all, we'll calculate. So, audit risk, auditor wanted to keep it at 2%, and the risk of material misstatement is 8% and multiplied by detection risk. Right? Now, 2 divided by 8 is equal to detection risk. Right? How much you will get? So, you will get around 25% because we need to convert into percentages. Right? So, detection risk is 25%. So, what is meant by detection risk? Auditor, he will perform audit procedures, right? Why auditor will perform audit procedures? To detect misstatements, right? Now, the risk that auditors procedures will not detect the misstatements is known as the detection risk. Now, is this the detection risk in the hands of auditor? Yes, detection risk is always in the hands of auditor. If he performs more audit procedures, then detection risk will be less. If he performs less audit procedures, then detection risk will be more. Right? Now, based on this 8% risk of material misstatement and auditor wanted to accept only 2% risk, audit risk, the detection risk should be 25%. That means 75% of risk of material misstatement has to be reduced by performing audit procedures. Got it? Understood? Yes. Now you can, from this formula of audit risk is equal to risk of material misstatement into detection risk, you can further derive that, see, audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. Okay, this inherent risk multiplied by control risk is nothing but risk of material misstatement. Got it? Done? Yes. So this is the formula for audit risk. Now we'll see here. Hope you understood this properly. So, risk of material misstatement. First of all, what is meant by a misstatement? This definition we have already discussed. Amount to, if there is a difference between amount to, classification, presentation, disclosure, that is ACPD. Amount to, classification, presentation, disclosure, we can call it as ACPD simply. Now, if there is a difference between ACPD, that is required as per applicable financial reporting framework, and ACPD that has actually been made in the financial statements, then you will call it as a misstatement. Now, next coming to components of audit risk. As I have already told you, there are 3 components. Inherent risk, which means susceptibility of an assertion to a misstatement that could be material either individually or when aggregated with other misstatements, provided there are no related controls. Next, control risk. Control risk is a risk that controls might fail to detect, prevent, correct the misstatements. Both of these together we'll call it as a risk of material misstatements, right? Next, detection risk is the risk that auditors procedures will not identify the misstatements, right? And this risk of material misstatement will be assessed at two levels, that is at each assertion level. That means for cash, for valuation of cash, how much risk of material misstatement. For existence of cash, how much risk of material misstatement. For existence of fixed asset, how much risk of material misstatement. Like this, at each assertion level you will calculate risk of material misstatement, and also for the entire financial statements as a whole. Next, what are the steps in identifying risk of material misstatements? There are basically 4 steps. First of all, you will identify the risk throughout the process of doing the audit. Once the risk is identified, you will assess that particular identified risk. Next, you will relate the identified risk to what can go wrong at the assertion level, and you will also consider the likelihood of misstatement. What is the likelihood of this risk occurring into misstatement? This you will consider. These are the 4 steps in identifying and assessing risk of material misstatement, right? Yes, sir. Now, in order to identify risk of material misstatement, you have to perform risk assessment procedures, right? The risk of material misstatement you cannot identify just by spitting. You have to perform audit procedures, right? And these audit procedures, they are of 2 types. One is risk assessment procedure and another one is the further audit procedure. Risk assessment procedures you will perform for identifying the risk as per SA-315. Once the risks are identified, the further audit procedures based on these risks, you will design your further audit procedures. Got it? Yes, sir. Now, these further audit procedures, they can be bifurcated into test of controls. Test of controls, testing the controls, simple. Next, substantive procedure. Substantive procedure means detailed verification of a particular item is known as substantive procedure. Detailed verification of an item is known as substantive procedure. Now, these substantive procedures, they are again of 2 types. One is the test of details. Example for test of details, watching. Watching is one of the example for test of details. Okay, these test of details, they can again be test of balances or test of transactions. Test of balances means auditing the balances that are present in the balance sheet. Test of transactions means performing test on total items. Okay, next, substantive analytical procedures. What is this analytical procedure? We will discuss as per SA-520. The beauty of this analytical procedure is that you can use analytical procedure as further audit procedure as well as the risk assessment procedure. Okay, you can use analytical procedure as both RAP and FAP. Now, what is meant by analytical procedure? Example of how you can use analytical procedure as a risk assessment procedure. So, in the last 5 years, the profit of entity is stagnant, but in the current year it has increased 400%. So when you compare the profit of current year with the previous trend, you found that there is a substantial increase in the profit. This is nothing but a analytical procedure. Comparing current year figures with previous year's trends is analytical procedure. So here you have used analytical procedure for risk assessment. If suddenly the profit has increased this much, means there could be a possibility of misstatement, there could be a risk of misstatement. So how you identified this risk? By performing analytical procedures, right? So analytical procedures, this way you can use as risk assessment procedure. Next, how you can use analytical procedure as further audit procedure? See, in the entity's profit and loss statement, total salaries is shown as 1 crore rupees. 1 crore rupees is the total salary expenditure. Now, in order to verify this salary expenditure, you can take bank statement, and you can take the pay slips that will be given to the employees, and you can verify each pay slip wise. This is one option. Another option is performing analytical procedure to verify these salaries. How you will perform analytical procedure to verify the salaries? You will ask the entity, how many employees are there in your organization? Entity says, we have 10 employees. Okay. On an average, monthly, how much salary you are giving to your employees? Okay. We are giving a monthly average salary of 90,000 rupees. Okay. That means 10 into 90,000, it becomes 9 lakh per month. So for 12 months it becomes 9 lakh into 12 is 1.08, right? 1 crore 8 lakhs. So by performing analytical procedure, you found the expenditure, salary expenditure as 1 crore 8 lakh, but actually it is 1 crore. So here what you have done? You have done analytical procedure to verify the salary expenditure. However, there is some increase of some 8 lakh additional expenditure you got by performing your analytical procedure. You will see why there is this difference. Okay, in my analytical procedure I got 1.8 lakh, 1.8 lakh, sorry, 1 crore 8 lakh, and here it is 1 crore. Why? Where the difference went? There could be some scenarios where some employees have joined and worked for only some months and they have left. Those employees might not be included in this 10 number of employees. Because of this additional 8 lakh might have arisen. Like this, auditor will inquire into the reasons. So basically here I am trying to explain you how you can use analytical procedure as both risk assessment procedure and further audit procedure. Okay? Yes, sir. Now, this risk assessment procedure is there. Now, there are 3 risk assessment procedures that you can perform. First one is understanding the entity and its environment. Okay, by understanding the entity and its environment, you can identify the inherent risk that is present in the organization. This is the first risk assessment procedure that you can perform. The next risk assessment procedure that you can perform is the analytical procedure that we have discussed just now. That is the second risk assessment procedure you can perform. And the third risk assessment procedure that you can perform is inquiry. By asking questions with various people, you can obtain understanding of the entity. Through the through inquiry also you can identify risk. Okay. Next, you can also perform inspection and observation. Inspection means inspecting the procedures that are going on. Okay. And observation. So this is also one of the risk assessment procedures. So by these risk assessment procedures, you will identify the risk. Okay, got it? Yes. So see, risk assessment procedures. Risk assessment procedure. Why these are performed? To obtain understanding of the entity and its environment, you will perform risk assessment procedure. These risk assessment procedures include inquiries, analytical procedure, and observation inspection. I have told you now. Now, as a part of obtaining understanding of the entity, what items you will understand? You will understand what is the industry in which the entity is operating. Is it a banking industry? Is it an insurance industry? Is it a car manufacturing industry? What is the industry in which the entity is operating? That you will understand. And what is the nature of entity, whether it is a manufacturing or it is a trading, and whether it is operating as a private limited company or as a public limited company. So what is the nature of the entity? Next, entity selection and application of accounting policies. Okay, how the entity is selecting accounting policies and how it is applying them. Next, entities objectives and strategies and those related business risk. Okay, objectives means what are the goals of the entity, and to achieve those goals, what strategies the organization is using. That also you will understand. So all these you are understanding for the purpose of obtaining understanding of the entity. Okay, see, you wanted to identify inherent risk. In order to identify inherent risk, you have to obtain understanding of the entity. Obtaining understanding of the entity means obtaining understanding of all these aspects related to the entity, like in which industry it is operating, what is the nature of the entity, and how the entity is selecting and applying this accounting policies. All these aspects you will understand. Next, measurement and review of entities financial performance. How the financial performance of the entity is being measured. Basically, we call them as KPIs, key performance indicators. What are the key performance indicators of measuring the performance of the organization? That you will see, right? Next, there is a concept of significant risk. What is meant by significant risk? Significant risk means important risk. See, significant risk means risk that require special audit consideration. And in order to call a particular risk as a significant risk, the likelihood of occurrence of that risk should be high, and magnitude of potential misstatement. Okay, if that risk occurs, the impact that it will create will be huge. Okay, so in order to call a particular risk as significant risk, the chance of its occurrence is huge, and if it occurs, its impact magnitude will be huge. If these two situations are there, then you will call it as a significant risk. Got it? Yes, sir. Next, consider following factors. So, in order to identify whether a risk is a significant risk or not, you need to consider certain 6 aspects. First one, whether that risk is risk of fraud. See, you always remember, risk of fraud is always a significant risk. Okay, risk of fraud is always a significant risk. Next, whether risk is related to recent significant economic accounting or other developments. Okay, whether the risk that has arisen is because of recent economic developments, recent industrial developments, recent policies issued by the government. Okay, if because of these things any risk has occurred, that automatically becomes significant risk. Next, complexity of transaction. If the complexity of the transaction is high, then that becomes a significant risk. Next, whether risk involves significant transactions with related party. This transaction with related party is also significant risk. In particular, transactions that are outside the normal course of business with related parties is always significant risk that we will be seeing. Next, degree of subjectivity in measurement of financial information. Okay, if degree of subjectivity means taking decisions based on emotions is known as subjectivity. So if the subjectivity involved is very high, then the risk is also high. Okay, because you are not taking decision based on facts, you are taking decisions based on your emotions, right? Next, transactions that are outside the normal course of business. Transactions that are outside the normal course of business means those transactions you will not enter into regularly you will not enter those transactions. Okay, like selling of a land. Will you sell the land daily? No, right? So if there is any risk in the transactions that are outside the normal course of business, then that risk becomes a significant risk. Got it? Yes, sir. Next, so these two things, risk of fraud and transactions with related parties that are outside the normal course of business, you will always treat them as significant risk. Got it? Yeah. Next, moving to internal control system. What is meant by internal control system? Basically, internal control system is a process which is designed, implemented, and maintained by whom? By those charged with governance, management, and other personnel. Why? For the purpose of providing reasonable assurance about what? About reliability of financial reporting, about effectiveness and efficiency of operations, about compliance with laws and regulations, about safeguarding of assets. Okay, to achieve reasonable assurance that entities' objectives with respect to these 4 aspects will be achieved. Okay, the processes that you will implement to achieve the entity's objectives with respect to these 4 aspects is known as internal control system. Yes. Next, so okay sir, just a second. Yes, I just bought some water. So, sir, during the audit, is it necessary to verify internal controls? See, auditor is not having any responsibility to verify internal controls. Okay, auditor is not having any responsibility to verify internal controls, but the audit that the auditor conducts is risk based audit. I have already told you. So there is a inherent risk for a particular item, right? And to overcome that inherent risk, certain controls will be implemented around that particular item. So in order to calculate the risk of material misstatement, auditor has to verify internal controls. So here auditor is verifying the internal controls not because he is having the responsibility to verify internal controls. No, auditor is verifying internal controls because to make his work of audit easy. Okay, otherwise auditor would have to do, or auditor would have to verify each and every transaction in detail if he doesn't verify his internal control. So in order to make his work easy, auditor is verifying the internal controls, but he is not having any responsibility to verify internal control. Okay, so as part of verification of internal control, if at all you identify any deviations, you will communicate them to management. Okay, so why it is necessary to understand internal controls? What are the benefits? So by understanding the internal control, you will identify types of potential misstatements. Potential misstatements means misstatements that might occur in future. Okay, that misstatements are not there in present, but they might occur in future. So such a type of misstatements we'll call them as potential misstatements. So by understanding the internal control, you can come to knowledge, you can identify potential misstatements, because if this is internal control and in this area there is a weakness in the internal control, then the potentiality for occurring misstatement in this area will be high, right? So by understanding the internal control, you are able to identify potential misstatements, right? Next, identifying factors that affect risk of material misstatement. Okay, for identifying risk of material misstatement, you need control risk. So for identifying the control risk, you should first of all understand the internal controls, right? That is also another benefit. Next, designing the nature, timing, extent of further audit procedure. So how you will design further audit procedures based on risk of material misstatement identified as per SA-315, you will design further audit procedures as per SA-330, right? Now to determine the risk of material misstatement, you first of all need control risk, right? So in effect, to design your further audit procedures, you should first of all obtain understanding of the internal control, right? Yes. Next, now I have already told you, if you implement the internal control, will they 100% detect the misstatements? No, there are certain inherent limitations in the internal control. In the first chapter we have discussed, there are inherent limitations in the audit. Just like audit is suffering from inherent limitations, even the internal controls are also suffering from certain inherent limitations. Let us see what are those inherent limitations. See, these internal controls, they can provide only reasonable assurance that misstatements have been detected, but absolute assurance cannot be provided. Next, human judgment in decision making. If at all there is a manual control. Manual control means a person is doing the control, like authorization, verification of the transaction. Now, in such a situation, the people, they will make decision making. The decisions that the people will make will be based on judgments, right? They will make decisions based on emotions. So, because of this judgmental decision making, also the internal control might not work properly. Next, lack of understanding of the purpose. If the person who is implementing the internal control implements that internal control without understanding the purpose of such internal control. Like in the regular class we have discussed about BRS. BRS is also one of the internal control, right? So if you prepare BRS without understanding the purpose of BRS, then there is no use of preparing the BRS. Next, collusion among the people. That means you have divided a particular work, segregation of duties between 3 or 4 people. Segregation of duties is also internal control. Now if those people they collude and commit a fraud, then this is also a inherent weak limitation of the internal control, collusion among the people. Next, judgments by management, limitations in case of small entities, because small entities they will be having lesser resources. With such lesser money or lesser resources, they cannot implement the internal control properly. Next, components of internal control. So these components of internal control we have discussed in the regular class. For a car to work properly, the steering, wheels, engine, all these components should work properly, right? So for a car there are various components. If all those components work properly, only then car will work properly, right? Similarly, for the internal control system also there are certain components. Only if these components work properly, the internal control system will work properly. What are those components? Let us see. Control environment. That means the environment in the organization should be friendly for implementation of internal controls. Okay, organization so environment should be internal control friendly. Got it? Yes, sir. Next, so some of the elements of these components, some of the elements of these control environment include communication and enforcement of integrity. That means all the staff in the organization should be having integrity. The environment, the ethical values of the employees should be very much high. Okay, next, participation by those charged with governance. Those charged with governance, they should not just tell the rules and ask the people to follow. Those charged with governance should also follow the rules. That is, there should be participation from those charged with governance. Next, management's philosophy and operating style. Organizational structure. What is the structure of organization? Who is the top level management? Who is the middle level? Who is the lower level? That organization structure also is also one of the element of control environment. Next, assignment of authority and responsibility, human resource policies and practices. So all these are components of control environment. Next, entities risk assessment process. Entities risk assessment process is second component of internal control system. Now, risk assessment. Who will do risk assessment? Will auditor do or the management do? The answer is both will do. First of all, management, they will do the risk assessment in the organization for establishing internal controls. After that, auditor, while doing the audit, he will do his risk assessment. So here, in the components of internal control, the risk assessment that we are speaking about is the entities risk assessment, not the auditor's risk assessment. Okay, next, control activities. Control activities are the actual internal controls that have been implemented. So what could be the actual internal control? Policies and procedures related to performance, information processing controls, physical controls, segregation of duties. Next, information system and communication. This is the fourth component, monitoring of controls. So all these 4 components should be continuously monitored. Only why you need to monitor? Because by properly monitoring the components of internal control system, if at all any lapses are found, if at all any weaknesses are found in the internal control, you can update the internal control system. So for the purpose of keeping internal control system updated, the monitoring of internal controls is required. Got it? Yes, sir. Next question, sir. Are all the internal controls relevant for the purpose of audit? First of all, internal controls will be related with respect to which areas? Okay, in the organization, internal controls will be not only related to financial reporting process, even there will be administrative internal controls also. See, firstly, are all controls relevant to the audit? First of all, there is a direct relationship between entity's objectives and the control it implements. Objectives means goals. So there is a direct relationship between goals of the entity and the internal controls that the entity will implement. So the internal controls will be with respect to financial reporting area, operations means day-to-day business operations, and compliance means compliance with laws and regulations and various other aspects. So internal controls in an organization can be with respect to these three aspects. Now controls over completeness and accuracy of information, whether controls over completeness and accuracy of information provided by the management is relevant for the purpose of audit. If auditor uses them for designing his audit procedures, for performing his further audit procedures, then these controls will be relevant. Next, internal control over safeguarding of assets or internal controls over safeguarding of assets relevant for the purpose of audit, generally limited to those relevant to reliability of financial reporting. Okay, only those controls that are relevant to reliability of financial reporting, that will be relevant. Next, controls relevant to objectives that are not relevant to the audit. Okay, if there are any controls that have been implemented relevant to the objectives that are not related to audit, like management has implemented a control with respect to hiring employees. Now, hiring employees for the organization is an administrative process. Controls in the area of hiring of employees is not relevant for the purpose of audit, right? So, if there are any controls related to objectives that are not relevant to the audit, then those need not be considered by the auditor. Next, the conclusion that I wanted to tell you is, not all the controls are relevant to the audit. Only those controls that affect financial reporting are related to the audit. Got it? Yes, sir. Next. So, by now you should have got an idea that auditor, he needs to verify internal controls in the organization. He will verify internal controls in the organization, even though it is not his duty. Now, extent of understanding of internal controls. So, as part of understanding the internal controls, what will be understood by the auditor? Auditor will understand how the internal controls are designed, what is the design of controls, and how those designed controls are implemented in the organization. After that, what is the operating effectiveness of those controls. So these three things auditor will see with respect to extent of understanding of the controls. Next, now for the purpose of understanding the controls, auditor needs certain information about the controls, about the internal control system. How to obtain information about internal control system? See, there are 4 methods that you can use for obtaining information about internal control system. First method is narrative record. What is meant by a narrative record? Narrative record is nothing but, in your school days you used to write essay, right? In the examination they would ask you a particular topic and ask you to write essay on that particular topic. Similarly, here narrative record is nothing but detailed description of how the internal controls are designed to implemented and operating in the entity. That is narrative record. Okay, complete and exhaustive description of the system of internal control system. Next, checklist. What is meant by a checklist? Basically, checklist will contain series of instructions that has to be answered by the audit assistant who is doing the audit. That particular person, he needs to answer the series of checklist, and the answers to this checklist will be either yes, no, or not applicable. Okay, next, internal control questionnaire. Internal control questionnaire is also similar to checklist, but checklist is answered by the audit assistant, right? Whereas internal control questionnaire, it will be given to the management, and management will be asked to give answers to these internal control questionnaire. Okay, that is the difference. And here also the answers will be either yes, no, not applicable. Okay, next, Flowchart. So what is flowchart? Flowchart is nothing but this is a flowchart. Okay, the chart that with which we are discussing the audit subject. This is a flowchart, right? So just like this, flowchart will be prepared with respect to internal control. How the internal control is there in the organization, a flowchart will be prepared. That's it. Okay, so that is the SA-315. Next, going to materiality. SA-320 deals with materiality. Now, what is meant by this materiality? See, here in case of audit, we will be using this term materiality with respect to misstatements, because auditor, he is not concerned with just misstatements. He is concerned only with material misstatement. Okay, if a misstatement is not material, then auditor will take it light. Okay, only if it is material, auditor will take it serious. Okay, so materiality will be defined as per SA-320. Now, when you will call a misstatement as a material, so those misstatements that will affect economic decision making of the users, then you will call that particular misstatement as material. So misstatements are considered to be material if they individually or in aggregate influence the economic decision of the users. And of course, determining the materiality is a matter of professional judgment. See, matter of professional judgment. Determining materiality is a matter of professional judgment. I will also tell you why it is a matter of professional judgment. While discussing formula for materiality, I'll tell you. And while making these professional judgment about materiality, okay, now only I'll tell you. Basically, for calculating materiality, the formula is benchmark multiplied by a percentage. Now, benchmark means, like examples of benchmark. Sales can be a benchmark. Profit can be a benchmark. Loans given can be a benchmark. So, you will take a benchmark from the financial statements, and on that benchmark, auditor will apply a percentage. Now, here, how the professional judgment is involved? How much percentage has to be taken? Should it be 1%, 2%, 3%, 4%? That will be decided by the auditor. So, the percentage is based on professional judgment of the auditor. That's the reason why determining the materiality involves professional judgment. Got it? So now, while making this professional judgment, auditor will make certain assumptions about the users. Users means people who are using the financial statements. So auditor will take certain assumptions about the users of the financial statements. What assumptions he will take? First of all, he will assume that users are having reasonable knowledge of the business. Okay, he will assume that users are not dumb people. They are having sufficient knowledge about business of the organization. Like this, he can assume, auditor can assume. Next, auditor can also assume that users will be able to understand that financial statements are prepared and audited only to the levels of materiality. Immaterial items, immaterial misstatements, auditor has ignored. Okay, auditor will assume that users already know that auditor ignored immaterial misstatements. Okay, yes. Next, auditor can also assume about the users that users will recognize the uncertainties inherent in the measurement of amounts. Obviously, in measuring the amounts, there will be uncertainty involved. Let's say, for example, you are making provision for bad debts. You made a provision of 1 lakh. Now, what is the guarantee that only 1 lakh will be the actual bad debt? Actual bad debt can be more than 1 lakh, na? Got it? So, the auditor can assume that users will recognize the uncertainties that are inherent in the measurement of amounts. Next, auditor can also assume that users can make reasonable economic decisions. Okay, these assumptions auditor can take. Next, of course, determination of materiality, it is responsibility of the auditor. Management will not determine materiality, right? Next, materiality is to be applied both in planning and performing the audit. Okay, basically throughout the audit you will apply materiality. Next, I have told you now, for the materiality the formula is benchmark multiplied by a percentage, and percentage, the amount of the percentage will depend on professional judgment of the auditor and what benchmark has to be taken. For determining the benchmark, whether sales should be taken, net profit should be taken, gross profit should be taken as a benchmark, for taking the decision certain factors has to be considered. What are the factors that will affect the benchmark? First one, elements of financial statements. What are the elements of financial statements? Okay, sales, profit, purchases, all these are elements of financial statements. You should see all the elements of financial statements before deciding a benchmark. Next, items on which users attention tends to be focused. Now, in case of banking companies, users will focus more on loans given by the bank. In case of trading company, users will focus more on sales. So in case of this company, on which item users focus will be more, that also need to be considered. Next, nature of the entity. What is the nature of the entity? Next, ownership structure. How the entity ownership structure is there. And volatility of benchmark. Volatility means fluctuations in the benchmark. The benchmark that you choose, it should not be volatile. It should be stagnant. Okay, or it should be moving in a normal trend, but it should not be with more fluctuations. Okay, some of the examples for benchmark are profit before tax, total revenue, gross profits. All these are some of the examples for benchmark. Next, basically this materiality is there. It will be determined at the financial statements level and also at the transaction or account balance level. That means for the entire financial statement level, you will determine a materiality. And let's say, for example, for the entire financial statements, you have determined materiality as 1 lakh. So only if misstatements for the entire financial statements crosses 1 lakh, you will be concerned with those misstatements. Now, there is area of sales. Now, auditor feels that area of sales is very much important. So, for the area of sales, materiality should be lesser than 1 lakh. Okay, the materiality that we have used for entire financial statements cannot be used for the sales. So, auditor has kept materiality for sales as 20,000 only. So, in the area of sales, if any misstatement crosses 20,000, auditor will ask the management to correct them. Okay, so here what I wanted to tell you is materiality will be determined at the financial statement level and also at account balance or transaction level. Okay, and auditor can determine different levels of materiality for different transactions. Okay, next there is a concept of performance materiality. What is meant by performance materiality? See, okay, auditor kept a materiality level as 1 lakh rupees, and only if any single misstatement or all the misstatements taken together crosses 1 lakh rupees, auditor is concerned with them. Auditor will ask the management to correct. Okay, now what if there is some misstatement of 80,000 rupees? This is not crossing a materiality level, but we have seen there are inherent limitations in the audit. So audit cannot identify all the misstatements. So even after you conducted the audit, there will be some undetected misstatements. So what if this misstatement of 80,000 plus there could also be some undetected misstatements? Okay, so there is high chance that this 80,000 plus the undetected misstatements could cross 1 lakh rupees, right? So to avoid this possibility, auditor will fix a performance materiality. Basically, performance materiality will be calculated as a percentage on materiality. See, I hope you are understanding. Now, materiality is calculated as benchmark multiplied by percentage. So let's say here for this, in this formula, you have taken benchmark as sales. Sales is some 1 crore rupees and 1% you have applied, and you have calculated materiality as some 1 lakh rupees. Okay, clear. Now you wanted to calculate performance materiality. Performance materiality is equal to materiality multiplied by a percentage. Now here in our example, materiality amount is 1 lakh. So 1 lakh multiplied by a percentage. Here for performance materiality, percentage will not be single digit. Like for the materiality calculation, the percentage will be in single digits, 1%, 2%, 3%, like this. But here the percentage will be some 70%, 80%, like this it will be. So for performance materiality, here we have arrived at 70,000. So once the misstatement reaches 70,000, auditor will become alert and auditor will ask the management to correct those misstatements. Okay, so this is materiality and performance materiality. Next, moving to SA-265, which is a small standard. Basically, now as per SA-315, you have verified some of the internal controls, and as per SA-330 also you will verify some of the internal controls. So if you have identified any deficiencies in the internal control, you have to communicate them with management and those charged with governance as per SA-265. Let us see. So SA-265, communicating deficiencies in internal control to management and those charged with governance. First of all, what is meant by a deficiency in the internal control? See, if the control is unable to prevent, detect and correct misstatements, then you will call it as deficiency. Or the control that is required to prevent, detect, correct misstatement is missing, completely missing, it is not present, then also you will call this as deficiency. Now there is also significant deficiency. When you will call a deficiency in the control as a significant deficiency, if the auditor feels that the deficiency or a combination of deficiency in the internal control is such that it is very much important to bring the notice of this deficiency to those charged with governance. Okay, in such a situation, you will call such a deficiency as a significant deficiency. Now, some of the factors that will be considered in determining a deficiency as a significant or not. See, likelihood of deficiency leading to misstatement. If, let's say for example, there is a deficiency in the internal control, now how much possibility this deficiency in the internal control can lead to misstatement? Okay, how much possibility is there that you will consider? That is one of the factors that you will consider in determining the significant deficiency. Next, susceptibility to loss or fraud. Susceptibility means the possibility. Okay, what is the possibility that this deficiency in the internal control can lead to fraud or loss? Next, subjectivity and complexity of determining estimated amounts. So how much subjectivity and complexity is involved? If more subjectivity and complexity is involved, then you will call it as significant deficiency. Next, financial statement amounts exposed to the deficiency. Okay, which financial statement amounts is exposed to the deficiency, that also you will consider. Next, volume of the activity. Okay, how much volume of activity is occurring in that area where the deficiency in internal control is there. If more volume of transaction is occurring, then you will call it as a significant deficiency. Next, interaction of deficiency with other deficiency. Okay, a deficiency in the internal control can interact with other deficiency and can make this significant deficiency. Got it? So these are the factors that will be considered in determining significant deficiency. Next, what is the communication process? How you will communicate to those charged with governance? First of all, you will determine whether one or more deficiencies are identified. Then you will see whether those deficiencies are significant deficiencies. Then you will communicate in writing significant deficiencies to those charged with governance on a timely basis. Okay, if you have identified any significant deficiencies, thus you need to communicate to those charged with governance on a timely basis. So in your communication, what should be the contents of your written communication? Let's see. Contents of written communication. Description of deficiency. The auditor, he needs to describe the deficiency in internal control to those charged with governance. In detail, you need to describe. Next, sufficient information to enable those charged with governance and management to understand the context. Okay, you should give the truth of information that is necessary to enable the management and those charged with governance understand the context of communication. In this context, you need to communicate or you need to include purpose of audit was to express opinion on financial statements. See, management and those charged with governance, my purpose of audit was to express opinion on financial statements. However, audit included consideration of internal control relevant to the financial statements. Yes, during my audit, I have considered some of the internal controls that are relevant to financial statements. And during such consideration, if I have found out any deviations in the internal control, only those deviations I am communicating to you. I have not identified all the deviations. See, matters being reported are limited to those deficiencies that the auditor has identified during the audit. Next, there are internal financial controls. Basically, internal financial controls means nothing but those policies and procedures that are put in place for ensuring reliability of financial reporting, effectiveness and efficiency of operations. This we have discussed in the definition of internal control itself. Next, compliance with applicable laws and regulations and safeguarding of assets and prevention and detection of frauds. So those are internal financial controls. Next, SA-330. So as per SA-330, auditor, he will design his responses are nothing but further audit procedures. Okay, for the assessed risk of material misstatement, auditor will design his responses in the form of further audit procedures. See, SA-330, auditor's responses to assessed risks. It deals with auditor's responsibility to design and implement responses to risk of material misstatement. So, as per SA-315, you have identified risk of material misstatement. For that risk of material misstatement, you will design your responses. So, your responses will be in the form of audit procedures. We have seen about these audit procedures in SA-315 only. Risk assessment procedure, further audit procedure, test of control, substantive procedure. They can further divide into test of details, substantive, analytical procedures. Test of details or of test of balances, test of transactions, right? Now, what considerations auditor will take into account while designing his further audit procedures? He will consider the reasons for assessment given to risk of material misstatement. Okay, I have identified risk of material misstatement as per SA-315. So, what are the reasons? Okay, what are the reasons for that risk of material misstatement? I will consider them for designing my further audit procedures. Next, likelihood of material misstatement. Okay, as per SA-315, I have determined the risk of material misstatement. What is the likelihood of this risk turning into misstatement? That also I will consider likelihood of material misstatement. Next, relevant controls. Okay, there are controls. What are controls operating and what is the effectiveness of those controls? That also I will consider. Next, more persuasive audit evidence. The higher auditor's assessment risk. Okay, if the auditor's risk is high, then more persuasive evidence the auditor will obtain. If auditor's the risk is less persuasive audit evidence the auditor will obtain. Got it? Yes. Next, nature and extent of test of controls. Now, the controls in the organization, they have to be tested. So, what is the nature of test of controls that you will perform? See, you will perform other audit procedures in combination with inquiry. Inquiry means asking questions about the internal controls. Next, determine whether the controls to be tested depend upon other controls. That is, whether there are any indirect controls that you will determine. Next, Inquiry combined with inspection or reperformance. Okay, you will do inquiry in combination with inspection or reperformance. Okay, in combination with these two audit procedures, you will perform inquiry. Got it? Yes. Next, nature of particular control. Okay, what is the nature of a particular control? That also you will consider in determine in deciding in a in deciding the nature of test of control. So because based on the type of control, the type of test of control, the type of testing you perform will differ, right? Next, matters to be considered in determining extent of test of controls. Extent means how much testing has to be performed. See, frequency of performance of control. Okay, if that control is being executed by the organization very much frequently, then you need to thoroughly test that control. Next, length of time during the audit period. Auditor is relying on the control. Okay, for how much period the auditor is relying on the control, that also will consider. What is the expected rate of deviation? That means how much rate of deviation could be there in the control. Relevance and reliability of audit evidence. Extent to which audit evidence is obtained from tests of other controls. All these you will consider in determining extent of test of control. Next, timing of test of control. See, based on the requirement, you will test the control either at a particular point of time or throughout the period. And auditor, during his previous audit, he would have obtained certain audit evidence, right? So whether I can use that same audit evidence that I have obtained previously, or should I perform audit procedures again? In making this determination, auditor, he will consider certain aspects again. Let's see. Effectiveness of other elements of internal control. Okay, whether other elements of internal control, are they working properly? If they are working properly, okay, let me use the same audit evidence that I have obtained in the previous year audit. Okay, if internal controls are not working properly, I will again test them. Next, see, these are some of the points that auditor will see to take a decision of whether to use the same audit evidence related to internal controls that I have obtained in the previous year, or I have to again test the internal controls. Risks arising from characteristics of control. This also you will see what is the characteristic of control. Effectiveness of general IT control. General IT control means we will be discussing this in audit of automated environment. IT controls are general IT controls and application controls. General IT controls will be applicable for entire organization, like user ID, password is general IT control. So what is the effectiveness of those general IT controls? Whether lack of change in a particular control poses a risk. Okay, if you follow the same control continuously, will that possess a risk? And risk of material misstatement. Establish continuing relevance of that control. So all these, what happened? Okay, just a second. So all these you will see in taking a decision of whether to use the audit evidence that you have obtained in the previous year, or perform audit procedures again. Next, certain specific inquiries that the auditor has to make when deviations from the control are detected. If auditor identifies, detects any deviations from the control, what specific procedures auditor has to perform? See, test of controls provide appropriate basis for reliance on control. Auditor needs to see whether the test of controls that I am performing, will they provide appropriate basis for me for relying on those controls, or I have to perform some more test of controls. Next, additional test of controls are necessary. Okay, or additional test of controls necessary, and potential risk of material misstatement need to be addressed using substantive procedures. Potential means the risk of material misstatement that might occur in future that needs to be addressed by performing detailed audit procedure. Substantive means detailed. Next, SA-450. So as per SA-315, you have identified the risk of material misstatement. Based on that, you have determined the audit procedures as per SA-330, and in SA-330 you have identified actual misstatements. Now these actual misstatements, you will evaluate those misstatements as per SA-450, evaluation of misstatements identified during the audit. First of all, we will see various types of misstatements. Misstatement, we have already seen the definition for misstatement, right? ACPD that is made in the financial statement is different from the ACPD that is required as per the applicable financial reporting framework. Then you will call it as misstatement. Uncorrected misstatements means those misstatements which are identified by the auditor but not uncorrected, but are not corrected by the management. Factual misstatement means by fact 100%, that is misstatement only. Next, judgmental misstatements means misstatements that arise because of judgments that the management makes. Differences arising from the judgments of management, like management has made a judgment that for the next year the provision for bad debts will be 1 lakh rupee, but actual bad debts occurred is 2 lakh rupee. So there is a misstatement in this provision. This misstatement is nothing but a judgmental misstatement. Next, projected misstatement. What is meant by projected misstatement? As per SA-530, you will take a sample from the population, and on sample you will perform audit procedures, and you will determine misstatements in the sample. Now you will project the misstatements in the sample to the entire population. This is nothing but projected misstatements. Next, clearly trivial misstatements. Clearly trivial misstatements means those misstatements which are very rare and which are of very small value. Okay, that means you have found the misstatement and that is clearly trivial. That means clearly very minute misstatement. Okay, such type of minute misstatements you will call it as clearly trivial misstatements. Auditor will, however, be not concerned with these clearly trivial misstatements. Okay, these are different types of misstatements. Now, as auditor does the auditor goes on finding the misstatements, right? Yes. Now, as and when you find the new misstatements, you need to consider those misstatements to see whether identified misstatements indicate that other misstatements might exist, and whether aggregate of misstatements could reach or approach materiality. So based on these two, auditor needs to decide whether I should revise my materiality level, whether I should revise my audit strategy and audit plan. See, determine whether overall audit strategy and audit plan needs to be revised. Okay, based on the new misstatements that you are finding as you are doing the audit, you should take a decision whether I can continue the same old audit plan and overall audit strategy, or should I alter, revise my audit strategy. Because in SA-300 also we have discussed, as the audit progresses, if you find new information, based on that new information, if you want, you can revise your audit strategy and audit plan, right? Next, misstatements identified during the audit, you need to properly communicate them with the management on a timely basis and ask the management, please correct those misstatements. If management refuses to correct the misstatements, you will understand why management is refusing to correct the misstatements, and you will consider the impact of this on your opinion. Okay. Next, communication with those charged with governance. You will communicate with those charged with governance what are the uncorrected misstatements and what is their effect, and effect of uncorrected misstatements related to prior periods. Okay, in prior period, if at all there is any uncorrected misstatement, what effect that will have. Next, request that uncorrected misstatements be corrected. Okay, you will once again finally request those charged with governance, please correct the uncorrected misstatements. Okay, this you will communicate with those charged with governance. Next, Evaluating the effect of uncorrected misstatements. While before evaluating the effect of uncorrected misstatements, see, you have identified the misstatements, and these misstatements you have communicated to management, you have communicated to those charged with governance, but they are not correcting them. If they are not correcting them, that misstatement become uncorrected misstatement. Now, this uncorrected misstatement, will you keep it like this only? No. What you will do, you will consider the effect of this uncorrected misstatement, right? See, you need to, before considering effect of uncorrected misstatement, you need to first of all reassess the materiality, whether the materiality level that I have determined earlier, can I keep it as it is, or I need to revise this materiality level. Next, in determining the materiality of uncorrected misstatements, auditor shall consider the following. What is the size and nature of this misstatement? Okay, this misstatement is uncorrected, management has not corrected it. Okay, what is the size of this misstatement? Is this material? If this is material, yes, I'll consider. If this is immaterial, okay, let it be uncorrected. This is immaterial, I'll leave it. So you should see what is the size and nature of that misstatement. Next, circumstances of their occurrence. In which circumstance that misstatement has occurred, and the effect of uncorrected misstatement. What effect this uncorrected misstatement will have on the audit? So these are the things that you will consider with respect to evaluation of effect of uncorrected misstatements, and this is SA-450. So by now we have revised all the 5 standards of 4th chapter, right? I hope you properly understood and revised this chapter. I'll be winding up this class as of now. We'll meet in the next class with a revision of new chapter. Until then, take care. Bye bye. See you.